From Tycoon News Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Welcome back to Options GPS. I'm Chris Rowe.
And I'm Ron Ianieri.
Now, what we're going to talk about next is volatility, which is one of the most important things to understand about options. And once you have a little bit of an edge on that, you can understand how to take advantage of other people's emotional bad decisions when it comes to trading stock.
Well, the first thing we definitely want to talk about, though, is how volatility fits into pricing. What you have to understand is when you look at all the different inputs to the pricing model, which we did in our last piece, you see that there's really truly only one variable. And that variable is the variable that determines a buyer from a seller or a seller from a buyer, and that is volatility.
Which is opinion.
And that's definitely right, because your guesstimate as to what volatility will be in the future is going to be different than mine. And that might make me a buyer and you a seller, or you a seller and me a buyer, or whatever combination that there is. But we've got to figure out first how it actually works mechanically in the model, how it affects option prices, and then, obviously, what types of decisions you're going to make based upon that number. You know that when volatility's high or volatility's low, people react in certain ways. I mean, you see it all the time.
Well, that's the easiest way to make a profit, is take advantage when other people are thinking emotionally instead of rationally. Once you could do that, that's the one thing that you have to understand about option pricing, volatility. Once you understand that everybody else is acting irrational, and everybody out there has seen times like that, like when the market's crashing, and you're going to find outrageous valuations that you could take advantage of if you disagree with it and you just keep a cool head. I'm going to show you a couple of different chart patterns, and I'm going to show you how you can identify them yourself. And when volatility is way too low, you can buy volatility, and Ron's going to show you how to do that. And when people are acting crazy and hysterical, you'll be able to capture big profits on that too, as long as you keep a cool head. I'll show you how to identify those times.
Obviously, since volatility is so important in the decision-making process, what we should do is start off with teaching what volatility is in and of itself, and then we'll branch off to more. So why don't I show people what vol really is?
Go for it.
Volatility is one of our more important topics that we'll be discussing. You have to understand that volatility is the primary component of extrinsic value. And extrinsic value is truly the essence of an option. When you think about options, an option with no extrinsic value really isn't an option, is it? When we think about deep in the money options, those that are trading just like stock, they don't have extrinsic value. And we don't even consider them options anymore. They say that that option is trading at parity. We said that it's like the stock itself. So when we look at options that are in the money with no extrinsic value, we talk about them as if they're not options. Then if we look at the other end of the spectrum, those options that are way far out of the money that have no extrinsic value, we say that they're not even an option anymore because they're worthless. They're like a lottery ticket. So where are real options? Well, they lie somewhere in the middle, somewhere between the way deep in the money and the way out of the money. And those options have a certain characteristic, and that is extrinsic value. So extrinsic value is truly the essence of an option. And if extrinsic value is truly the essence of the option, then volatility is incredibly important, because volatility determines the amount of extrinsic value in an option. And if there's one single topic that I think individual investors get stuck on, it's volatility. Not understanding what volatility is, how volatility moves, and how it changes the price of options. So when we're taking a look at all of our pricing model inputs, we said that we talk about stock price and strike price, days to expiration, interest rate, dividends. And we said between a buyer and a seller, all these little inputs in black are pretty constant between the two of us. Me being the buyer, you being the seller, or me being the seller, you being the buyer. The thing that separates me from you, me wanting to be a buyer, you wanting to be a seller, is our volatility assumption. So of all the different inputs in the model, there's only one that's not constant between me and you: volatility. And that's determining whether I'm a buyer or you're a seller. So first we have to understand what volatility is before we can understand what it does and how it changes option pricing. First, let's just go with a pure textbook definition. Annualized statistical measure of the dispersion of returns for a given security. How much does this thing move around? That's what volatility is telling us. We know that a stock doesn't keep the same price or even the same price level for very long. It fluctuates. Nothing goes straight up, nothing goes straight down. It bounces around. What volatility does is it measures the amount of bounce around that a stock is going to have. So we need to understand volatility because volatility tells us, along with time, the potential range of the stock for our given time frame. Once we have that range, we can then go ahead and put forth percentages for percentage chance of occurrence inside that range. Volatility and time give us that range. There's a few types of volatility definitions, a few different types of volatilities you're going to hear about. Some you might have already heard about. First, we have historic volatility. That's actually the easiest. A lot of people call it statistical volatility. The actual volatility that a individual security traded at for a given period of time in the past. Now that's measurable. I can look back and say, hey, this stock's fluctuation was this on this day, this on this day, this on this day, and I can get an actual real statistical read on what volatility really was. That is historic volatility. And when we talk about historic volatility, we're talking about the volatility of the underlying security for a certain period of time in the past. The only problem is we're not trading in the past. We're trading where? In the future. So future volatility is very important. The definition of future volatility is the volatility that an underlying security will trade at between now and sometime in the future. Pretty simple definition. As simple as the definition is, understanding what that number might be and figuring that out ahead of time is extremely difficult. We know that we have a historic volatility level of the underlying. In order to determine the future volatility of an underlying, we can only guess. No crystal balls, remember? So future volatility is what we're looking for. What is going to be the volatility of that security in some given future time frame? Now, obviously, we don't know that, and we don't know it until afterward. And afterward, it's become historic volatility. So what we need to do is somehow guess as to what future volatility is going to be. And that guess, our guess, is known as our forecast volatility. What our guess is to what future volatility will be. So everybody has their own forecast volatility. I've got one, you've got one. If mine overlaps with yours, we probably have a trade. But the fact of the matter is no one's certain as to where volatility will be in the future. And no one knows what your forecast is. No one knows what my forecast is. Obviously, I'm not going to tell someone, because if I told them what my forecast volatility is, I would be insinuating to them what price I'm willing to pay, what price I'm willing to sell at. It's kind of like going into a car dealership. When you walk in to buy that new car, you don't walk in and tell them the absolute top price you'll pay right off the bat. Hey, by the way, I'm looking to buy something for $25,000, but I can spend $40,000. Guaranteed he's putting you in a $40,000 car. We don't want to let somebody else know what our forecast is, what we can do, because we want to try to be able to get everything at a cheaper price if we're a buyer or a higher price as a seller. So we keep this forecast volatility under wraps. We keep it to ourselves. But there is a way for me to figure out what your forecast volatility is. Obviously, you're not going to tell me. But in what your actions are, I can read into what your forecast volatility actually is. And that brings... Now, when we start talking about volatility, we have to understand about different volatility levels, because volatility is obviously an annualized number. We know that. We've already stated that. Whatever volatility number you get, 30, that means 30% for the year. 70, 70% for the year. So it's an annualized number given as a percentage. But what does that mean? One thing that we have to understand is volatility is mean reversive. That means it has a tendency to snap back to the average. So we have a volatility level that is an average volatility level for a given stock. Most stocks trade with a certain average volatility. That's important because you're going to realize that volatility is a relative number. That means that when we talk about volatility in the stock market, 90 might be low, 30 might be high. And you might say, well, wait a second, how can 90 be low and 30 be high? 30 is much lower than 90. No, it's not. Not on a relative basis. You see, if I'm trading a stock that normally has a 130 volatility level, that's its average, then 90 is low for that stock. Meanwhile, if I'm trading a stock that normally has a volatility around 20, 30 is high. Why? Why is 90 low and 30 high? Because volatility is relative to the issue you're looking at. Now, because it's relative, we know that every stock has to have an average volatility. And thus, we can figure out what can be considered high or low based upon that individual stock's average volatility. So high and low, don't just think about higher numbers and lower numbers. You've got to think on a relative basis. Volatility is a relative number, and it's mean reversive. So when I take a look at a stock that normally trades at 130 volatility, that's currently trading at 90 volatility, I can actually expect volatility to rise, to revert back to its mean of 130. Does it happen all the time? No. Does it happen instantaneously? No. But over the course of time, it will revert to its mean. That gives me an idea of high and low levels of volatility, which is important. Now that I understand that volatility is relative and I understand that it has a mean, I can now speak intelligently of high or low volatility. And in high volatility situations, certain strategies will work better than others. You can't just learn one strategy and apply it to everything. It doesn't work that way because sometimes volatility might be high. Certain strategies will be better than others. However, when volatility is low, other strategies will be better than the other ones. We need to understand an overall general idea. Am I trading in a high volatility situation or am I trading in a low volatility situation? Now, when we talk about volatility pricing and we say volatility is high, what we're saying is volatility is high relative to the mean of this security. This security and that security are two different things. Vol high here might be vol low over here. You've got to stick to the one single security when we talk about high and low. Now, when when volatility is high, option prices are said to be expensive. The more a stock will move, the more doubt as to its outcome. With more doubt to the outcome of where the stock is going to be, we have higher prices in the options because more options will be affected in terms of their chance of being in the money or out of the money. We'll take a look at that in a minute. Meanwhile, when volatility is low to its mean, we can say that option prices are considered to be cheap. Less movement, less doubt. Less doubt, less money. So when we have a situation where we've identified a mean volatility and then said, okay, where's volatility relative to its mean? It's low. It normally indicates that option prices will be cheaper in that situation. And that could lead us to one strategy over another. Now, when we talk about high and low, we have to realize that we must look at apples versus apples and oranges versus oranges. The volatility level of a stock for a month is going to be different for the volatility level of that same stock for a year, which will be different from the volatility of the same stock for 3 years. We have to understand that we need to match the amount of days of expiration to the time that we're looking at volatility. What I mean by that is we don't want to be trading a 30-day option looking at a 60-day volatility chart. We don't want to trade a 1-year option looking at a 30-day volatility chart. If we're going to trade a 60-day option, we want to know what volatility levels are normally like for a 60-day period. Not a 180-day period, not a 5-day period, a 60-day period. So it's important to know that when we are looking at volatility, we must compare like time frames. I'm looking at a 7-month option, I want to look at 7-month volatility. I'm looking at a 2-month option, I want to look at 2-month volatility. The time period between what we're observing in volatility level and what option we're trading must match. Now, you might say, how do we do that? Easy. There's a little tool called a volatility cone. And what that volatility cone does is it determines where the volatility levels are for every given single time period. And that allows you to take a look at the relativeness of that volatility level to what the mean is. Now we can decide, hey, I'm looking at a 6-month option. I'm looking at a 6-month volatility chart. The 6-month chart tells me that the average volatility for 6 months is 30. And this option right now is a 25 volatility option. I am looking at a cheap option. Why? Because for a stock that is normally trading at 30 volatility for that period of time, I have a chance of buying an option that is only priced for 25 volatility. The vol is low. That means the option is probably undervalued at that time. But we have to make sure that we're using the right tools in the right way, especially when we're using that to make decisions on something as important as volatility. Here's a little picture of a volatility cone. And what the volatility cone does is, it's got all the days to expiration down here along the bottom, and the volatility levels. What the volatility cone does is it breaks down your volatility time frames into different days. If we're going to trade a 30-day option, we want to take a look at what volatility is normally like for a normal 30-day period in time. We don't want to look at what a 60-day period did or a one-year period did. We want to look at a 30-day period. And if we take a look here, we see that for a 30-day period, the average volatility is around 40. So if we're looking at an option that's got a 50 volatility right now, 50 is pretty high. It's above the second standard deviation, and it's pretty doggone close to being the highest volatility recorded for any 30-day period. On the downside, we could see that 30 volatility looks pretty low. It's pretty close to the lowest it was ever for a 30-day period, and it's below its second standard deviation. This is not only giving us the idea of high or low. The volatility cone is giving us an idea of how high and how low. That's important. Remember, anything above that second standard deviation only occurs how frequently? Only occurs about 13% of the time. Same with below this second standard deviation. When volatility is above the second standard deviation to the upside or below second standard deviation to the downside, we know that we are in rare air. Volatility is very rarely up that high. It's very rarely down that low. That gives us not only a sense of overall generalized high and low, but how high and how low, and the frequency of this occurrence. Now, a lot of different ways to calculate volatility. Most people, industry standard is the close-to-close volatility calculation. And what that means is I'm going to take a look at where the stock was yesterday, where it closed, and where it closed today, and I'm going to take the difference between the two as my data point, as my amount of fluctuation. And I'm going to do that over whatever period of time that I want to observe, taking all those little data points together and put together where volatility was for that period. Now, the close-to-close is, when I mean widely used, I mean really widely used. Very few people use anything other than the close-to-close method. And it's very generally accepted by everyone. Problem is that although it's the default model of the industry, although just about every broker in the world uses it, there's a little bit of a flaw. And that flaw is you can miss an intraday movement. Think about a stock that's trading at $50. It trades up to 60, drops down to 40, closes back at 60 at the end of the day. Close to close says, hey, look, you closed at 60 yesterday, you closed at 60 today, no movement, no volatility, zero. But this is a stock that ran from 50 to 60, 60 back down to 40, 40 back to 50. In one day. You can't tell me that there's not volatility there. That's extreme volatility. The close-to-close method quite often misses the intraday movement. So like any other type of model, somebody says, hey, you're missing the entire intraday movement. Better figure out another way of doing this. A gentleman by the name of Parkinson comes out with the high-low calculation. Instead of going from close to get the data point, he says, look, that misses the intraday movement. Let's go intraday. Let's take today's high and today's low and take the difference of those two as the data point. Not a bad idea. But there's only one problem. The flaw there is that misses the intraday gaps. The difference between last night's close and today's open. And as you know, even on normal days, that's normally the opening. Last night's close, today's opening is a huge piece of the overall movement of the stock for that day. You can't skip that. So although great for finding true intraday movement, great for day traders, Parkinson's basically fell short of the performance of the close-to-close calculation because of that missing the opening gap. Well, there's got to be a way of like kind of bridging the difference between these two calculations. And that's where Wells Wilder came in. Pretty bright guy, that Wells Wilder. He came up with something called average true range. His goal was to take the accuracy of Parkinson's high-low method to get the real true intraday range, and the close-to-close method that captures that opening gap. And he tried to put these together. So what he did was he pretty much put together the latest and the greatest of the volatility calculations, average true range. And what he said was, look, it's not just going to be one number. We're going to try to calculate volatility in several different ways, and we're going to take the best, meaning the highest number of those ways. So what he tried to do was incorporate both intraday movement and that gap, that opening morning gap. And the way he did it was he said, look, this is what I'm going to do. I'm going to take last night's close and today's low, and I'm going to take that data point. I'm going to then take last night's close and today's high, take that data point. And then I'm going to take the intraday range, the actual Parkinson high-low method, and take that data point. So he's sitting there with 3 data points. And he says, now I'm going to pick the biggest one, because the biggest one is the one that's going to give me the truest idea of the full total range of the stock that day. Wilder's average true range. Not bad. Actually, surprised that not more people use it. But obviously the brokers would have to then put more money into their platforms, put more money into the models, have stuff recoded. And you know what? It's probably not going to make that much of a difference to an individual investor that often. For a trader on the floor, if you want to go and become a market maker, maybe it's going to have a little difference. But for most people, individual investors, you don't need to be that ridiculously accurate. Now, of course, I noticed the problem with Wells Wilder's average true range. So I actually developed my own method of collecting the data points for volatility analysis. And I called it the adjusted close. You see, the problem is that where Wells Wilder covers some of the gap and some of the intraday range, he never really captures both of them added together perfectly. That's what I tried to capture. The reason I did was because I was a market maker on the floor, trading back and forth every day. I needed to have a much better idea of the potential full range of the stock. Not just from 1 point up or 1 point down. I needed to measure a point from the low to the high, and what happens if the stock trades back down again and then back up again? I needed to capture more in terms of my data points. So what I did was I developed a little method that combines the intraday movement and the opening gap together. And where that really becomes helpful is to gamma traders. Take it, slow down, we'll get there. We'll talk about gamma trading later. So there's a lot of different methods to calculating volatility. What I found is it's not so much that you need to be that accurate with calculating the number. What you more need to do is be certain of what to do with the number once you've calculated it. Now, in a perfect world, every volatility of every option will be equal. Every call, every put in every month at every strike will have the same volatility. After all, isn't that the assumption of the Black-Scholes model? Isn't that one of the flaws? What you need to do is grab your platform, open it up, go in, pick any stock you want, and look at all the different options. And look at the bids implied volatility and the ask implied volatility. Look at it for both put and call, for every month, through every strike. You tell me if they're all the same. Obviously, the answer is no. They're not all the same. That is what the volatility skew is. Volatility skews can take many different forms. There are vertical skews, there's horizontal skews, there's all different types of skews. What does a skew mean? When we think of the term skew, we think of something being bent out of shape a bit, twisted or turned differently. That's what it means in the options market. It means that not all volatility levels in each individual option for every different month, for every strike, is the same. They're all different. And that is what a skew is. Now, here's the thing. Based upon the option pricing model, and the mathematical relationships that truly exist between calls, puts, and the stock, and we're going to go through them later in synthetic positions. I'm going to show you all those calculations. Due to those mathematical relationships, there are certain groups of stocks, certain combinations of options that have to trade at an equivalent level. And when that equivalent level has different volatilities, a skew occurs. Now, it's important to understand what these skews are and what those skews indicate to us. But you also have to understand that different strategies will be optimal or not optimal based upon the volatility skew of the options you're looking at. We need to understand these skews and not so much be able to give me the formula for calculation, but what I need you to do is understand the skews so that you know which strategies would work better with certain skews, which strategies would work better with other skews. That's the real key here, not the math. Now, when these levels are not balanced, we have a skew, a volatility skew. So when you hear the term skew, don't get all crazy. Skews exist all the time in every market, every day, every strike. If the volatilities are not equal straight across the board, they're skewed. That's all. No big deal. Now, skews exist in every single relationship in options. They exist between a put and its corresponding call. They exist between in-the-money calls and in-the-money puts. They exist between out-of-the-money calls and out-of-the-money puts. They exist between different strikes, between different months. There's a ton of them. You don't need to know everything about skew and how to calculate it. But what you do need to know is when I have the number, what to do with it. Now, first skew that we talk about is something that you might have even heard of before. It's a vertical skew. It's a skew between the different strikes in the same given month. It's called the volatility smile. We also have a horizontal tilt. That would be a tilt between the same strike of different months. We've got a put-call skew. The put-call skew tells us the differential between volatilities of two corresponding options, a put and a call. We've got a negative skew. We talked about this earlier. That negative skew shows us when the out-of-the-money puts are trading higher than their equidistant out-of-the-money calls. We also have a positive skew, the opposite. And we talked about that when we said a lot of the stocks that are based on a limited natural resource, those stocks trade with a positive skew. What is a positive skew? It's when the out-of-the-money calls trade higher than their equidistant out-of-the-money puts. So we've got several skews here. It's not a lot, and they're not real difficult. But understanding how these skews will affect the prices of the options is important, because that's going to lead you to either picking the right optimal strategy for the situation or potentially not picking the right strategy. And let me tell you something. It's always easier to make money when you do everything right. It's hard enough that way. When you start messing things up, it makes it real difficult to make money. First topic here, volatility smile. The volatility smile is a vertical smile. Why do we call it vertical? Because it's up and down. We're looking at all the options in the same given month. And we're looking at those same month options from strike to strike. Now, here's the thing. For any given time period, the stock can only trade at one volatility. So if we're looking from now to May, we know that whatever that volatility level is going to be from now to May, there's only going to be one of them. There can only be one of them. Then how can all the options in May trade at different volatility levels? Well, there is an answer, and you probably already know that answer. You just don't know that you know that answer. Let me remind you what that answer is. Log normal distribution, skew and kurtosis. That is what's going to change the different volatility levels of the different strikes in a given month. So we already know why this is occurring. We just want to see what the effect is itself. So we know the stock can only trade at one single volatility level for any given time period. That means that we should see, somehow, some way, we should see all of these options in a given stock in the same month get to the same volatility level. But if you look on your platform right now, you'll see it's not true. So, what do we have? We have a skew, the volatility smile. Although all these different options in the same given month should be trading at one single common volatility level, they don't. And because they don't, they are said to be skewed. And when that skew occurs vertically in a single month between different strikes, it is called the volatility smile. It's a vertical skew. Now, there are some common traits to the volatility smile from stock to stock to stock. Trait number one, normally the at-the-money option trades at the lowest volatility level of the month. That's the base, that's the bottom. We'll talk about that a little later as to why when we get into a subject called the Greeks. But for right now, it's okay to know that most of the time, did I say all the time? No, I didn't. I said most of the time, you are going to find that your at-the-money option trades at the lowest level of volatility in the given month. Your out-of-the-money options and your in-the-money options trade at levels higher than that. The further you go out of the money, the higher the volatility goes. The further you go in the money, the higher the volatility goes. What does that create? It creates a graph that looks like a smile. Now, the one thing we need to know is that as the volatility assumption in each of these given strikes increases, the price of those options increases. So over time, when options expire and the volatility levels come back down to zero, because what? At expiration, there is no more volatility. The option is dead. It's done. The month is over. It's expired. There will be no extrinsic value left. If there's no extrinsic value, then there is no implied volatility anymore. So what we do understand is these smiles that we see eventually at expiration will be flat. Certain option strategies could be affected adversely by this situation if the smile is too peaked or too pronounced, or if the smile is too flat. We need to know which strategy is advantageous in a situation of a volatility smile and which strategy to potentially stay away from under these given conditions. Now, why is it called a smile? Well, all you have to do is look at a chart. If you go forth and chart out the volatility levels for each strike of any given month, knowing that the at-the-money is normally the lowest, this is the type of chart you're going to see. The volatility smile looks like a smile, and that's why it got its name. Somebody's got to tell me. Somebody out there knows the answer to this. Based upon what I've said and based upon the smile you see, where do you think the stock is trading right now? Well, we did say that in any given month, the at-the-money strike normally has the lowest amount of volatility. There it is right there. And if that is the at-the-money strike, then the stock should be trading right around $70. Now, on your Thinkorswim program, you're able to go ahead and take a good look at a bunch of these different volatility charts. And take a look at the smile and see how the smile lines up with the base of the smile being at the at-the-money strike. Knowing this, you can get a good general idea of where the stock is trading simply due to the volatility levels of the options. Here's a chart of a volatility smile for the different months right off of the platform I use, Thinkorswim. And if you take a look here, what you see is a base forming right around 65. And there's a couple other things that you're going to notice here. Number one, March is marked by X. Take a look at the X's. One color, red, is your put, green is your call. Look at this. That smile is much more peaked, much more robust than all these other smiles. The next one is your April. See the plus signs? Coincides with April. So your front month smile is the most peaked. What's the second most peaked? Your second month smile, April. And the further out we go, the less smile the options have. So when we look at this, what we should start seeing from a standpoint of overall general characterization of the volatility smile, the volatility smile is always most pronounced in the front month. And as we go to the outer months, it flattens out. That just goes to show you that the volatility smile is also subject to mean reversion, just like volatility itself. Here's another chart of volatility. Another time where we're looking at the volatility smile. Different colors or different months. And finally, this chart here. We have another situation where we've got a volatility smile. This exists in many, 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 many different markets. Not only in the stock market, in the currency markets, index, commodities. Any market has these volatility skews in its options. If there's options on it, there's a skew there. That's why it's important to become comfortable in understanding of these skews. So we've taken a look at all the different options in a single month. Now what we've got to do is take a look at all the different months across one single strike. That would be the volatility tilt. Now, the volatility tilt is known as a horizontal tilt. Why? Because we're looking at the same strike across a bunch of different months. Same strike, month to month. That would draw a kind of line sideways like that, horizontal. Now, different months across the same strike trade at different levels. Again, when we get to the Greeks, you'll start seeing why this is true. All you need to know right now is that it is true, and check it out for yourself. Make sure that you see this effect. Most of the time, when you were looking at the volatility tilt, we are looking at volatility levels that are declining over time. That means that normally, for any given strike, the front month trades at the higher volatility level, and as we look out across that strike from month to month to month, we normally see a decreasing volatility level as we go further and further out. So your front month options trade at the higher vol, your out month options trade at the lower volatility. So when we plot these volatility levels on a chart, we get a tilt. Something starting in the top left and moving to the lower right. A tilt. Now we could see this tilt across many different types of stocks. Matter of fact, we could see the tilt right here. And we could even take a quick look at the volatility smile from here. Stock price is 65.50. That means the at-the-money option is the 65s. Look at that. The at-the-money option, the 65s, are trading at a 45 volatility level. Look up and look down. See how the volatility level increases when we move away from that at-the-money in either direction? There's your volatility smile. Lowest at-the-money increases as we go out, increases as we go in. There's the smile. And that smile exists in every single month. Not as pronounced as in the front month, but it still exists month to month. The tilt is working the other way, horizontally. As we can see at the 65 strike, we have the Junes trading at a 45 volatility level, but the Julys are less. They're trading at 44. The October is even less than that, 42. And finally, the January is down at 39. That tilt also extends across all the other different strikes. Now, you might wonder why the volatility tilt is the way it is. For any given strike, and right now we're looking at the 50 strike, for instance. For any given strike, we start off with a flat volatility level. And what you're going to learn about in the Greeks, coming up soon, is you're going to learn about something called vega, or volatility sensitivity. What happens is, front month options have a smaller volatility sensitivity than out month options. If I wanted to take all my option prices up, increase the value of them, I would move volatility up. But here's the thing. Since each different month has a different volatility sensitivity, or vega, I might have to take some months up more than others just to keep things in balance. So if I wanted to take my option prices up, say, 20 cents, I would have to move June up 4 volatility ticks, because June has a 5-cent vega. And guess what? You can see this on your trading sheets. Turn to your trading sheets, you'll see what I'm doing. Meanwhile, if I want to take September up 20 cents, I would only have to move September up 2 ticks. Why? Because September has a 9-cent vega. As all these different vegas come into play, different months get moved up different amounts. I only have to move December up 1 tick. January doesn't even move up a full tick. It only moves up a little bit. What have I created here? A volatility tilt. All these tilts are basically in effect simply to keep the price of options in line. Remember, I said there's a mathematical relationship between the prices of all these things. You can't move one thing up without moving the other things up. Things get moved via changing in volatility. That's why these skews occur, to keep prices in line. Another skew, the put-call skew. You're going to learn that a put and its corresponding call are actually the same thing. That's right. A put is a call, and a call is a put. One of the first lessons we learned on the floor. And when we get into synthetic positions, you'll see exactly why. But for right now, when we talk about 2 corresponding options, you already know from the beginner class that when we talk about corresponding options, we are talking about a call and a put that have the same month and same strike. June 40 call, June 40 put. They're said to be corresponding. Well, those 2 options have a mathematical relationship. Their volatility levels mathematically should be equal, but they're not. And when that happens, it creates what is known as a put-call skew. It's when the corresponding put and call trade at different volatility levels. When that happens, we are said to have a put-call skew. Now, negative put-call skew is when we're looking at 2 corresponding options, a put and a call of the same month and strike, and the put is trading at a higher volatility level than its corresponding call. The June 40 puts trade at 30 volatility, while the June 40 calls trade at 28 volatility. That is known as a negative put-call skew. It's not a negative skew. It's a negative put-call skew. Make sure you say it right, because negative skew, plain old negative skew, means something else. Negative put-call skew means that the put is trading at a higher vol than its corresponding call. We also have a positive skew. That is when the call is trading at a higher volatility level than its corresponding put. Positive skew. That would be, say, for instance, the call trading at 70 volatility, while the corresponding put is only trading at 68 volatility. That would be a positive put-call skew. This only occurs in corresponding options. We've got to be talking about the volatility levels of corresponding options, put-call skew. When there is a negative or positive put-call skew, do understand that there are some opportunities in terms of preferential pricing that can be taken advantage of. We'll learn about taking advantage of these skews later. First, what we need to know is that they exist and what they are. So people always say, well, Ron, why do I need to know skews? Right here. Because you can take monetary advantage of these skews. You're not going to make millions of dollars just off of taking advantage of these skews. But you can add a little bit of money to every trade you do if you have the right skew. Now, we've talked about put-call skew. Negative put-call skew, positive put-call skew. I want you to say that for me. I want you to say negative put-call skew. Say it. Come on, say it. You've got to use the right terminology. The reason is because you can't just say, oh, the put and its corresponding call are trading out of balance, and since the put is higher, it's negative skew. No, it's not. It's negative put-call skew. Negative skew here is something totally different, and you have to say it right, because if not, you'll be talking about something that you don't think you're talking about. Negative skew. This compares the volatility pricing, the volatility levels of out-of-the-money options, out-of-the-money puts versus their equidistant out-of-the-money calls. Negative put-call skew compares a call and a put, corresponding call and put. It's comparing corresponding options. Negative skew is comparing an out-of-the-money option, out-of-the-money puts, with another out-of-the-money option. They will be in the same month, but these will not have the same strike. Since they have different strikes, they're not corresponding options. So everybody sure they understand the difference between negative put-call skew, positive put-call skew, and regular negative skew, and in a minute, regular positive skew. You got to say the right terminology. So, when we have a situation where the out-of-the-money puts are trading at a higher volatility level than their equidistant out-of-the-money calls, we are said to be trading with a negative skew. We talked about this already. Remember Dell Computer? Remember how it had all those real big one-day movements, many more than the bell curve said should happen? We said we had to use kurtosis to pump up the value of those out-of-the-money options. Remember that? But remember we said we didn't pump up both the calls and the puts equally? We said that we were going to skew them. Because there was more downside events, we were going to pump up the puts more than the calls. That created what? A negative skew. We took our out-of-the-money puts up to higher volatility levels than we took the out-of-the-money calls up. Negative skew. What is it telling me? If I see a stock right away that's got a negative skew, where the out-of-the-money puts are trading at higher volatility levels than the out-of-the-money calls, What is that telling me? It's telling me that there's a bigger tendency for the stock to move down large than to move up large. And that's why the negative skew exists, because there's more value in my out-of-the-money puts due to the tendency to more downward movements than there is for upward movements, and that skews our puts higher than our calls. Negative skew, more tendency toward downside movement. Now, remember, this skew is not put-call skew. This is a relationship between non-corresponding out-of-the-money puts and calls. Their strikes are different. If their strikes are different, they are not corresponding options. Negative skew, comparing out-of-the-money puts to out-of-the-money calls, with the puts being pumped up more. Tendency toward downward movement. So, we're increasing one side more than the other whenever we skew something like this, aren't we? We're favoring the downside. What is that telling us? We are creating a log normal distribution. Why? Because remember, the bell curve needed to be symmetrical? If we have a negative skew, it means we pumped up the downside more than the upside. We did not adjust symmetrically. We favored one side over the other. In this case, the downside. The puts are now more valuable than the calls. Out-of-the-money puts versus out-of-the-money calls. We have now changed our bell curve from a normal distribution to a log normal distribution. We also have positive skew, which is simply the opposite. And remember, we talked about that too. We said that we might see a lot of stocks that are based on limited natural resources having a positive skew, where the out-of-the-money calls trade at a higher volatility than the out-of-the-money puts, equidistant out-of-the-money puts. That's what we're talking about, positive skew. Now we're going to raise the out-of-the-money calls up more than we raise the out-of-the-money puts. We are skewing the long side, the upside, the positive side, creating a positive skew. This is saying that there's probably more of a tendency for the stock to have big upward movements than to have big downward movements. Because of that, we want to increase the value of those upside calls as opposed to our downside puts, because now the calls have a better chance of becoming in the money. The stock has a greater probability of running up than it does down. Again, when we're talking about positive and negative skew, you've got to understand that we're not talking about corresponding options. Corresponding options, that skew is a put-call skew. This is not. This is comparing out-of-the-money options with equidistant out-of-the-money options. Out-of-the-money calls, equidistant out-of-the-money puts. Again, this positive skew is taking our bell curve from a normal distribution, now changing it to a log normal distribution. We are skewing it. We are changing our bell curve. We're favoring one side over another to account for the increased probability of occurrence in one direction or another. Think about that for a second. That's really spitting in the face of random walk, isn't it? Random walk says that either side should occur just as equally, just as frequently. We're saying, hey, this is the real market. This isn't a textbook. This is the real market. We're going to skew the upside, or we're going to skew the downside. For whatever reasons we have, we are going to bend that bell curve and make it into something else, a log normal distribution. Now, our understanding of volatility can make us or break us. If we have a good grasp on understanding volatility, it's going to make things a lot easier for us. We're going to be more often than not choosing the right strategy at the right time. if we don't understand how volatility can affect us, we can have the opposite happen. We could actually start choosing the wrong option. Remember, we need to do more than just get a good idea of where the stock is going to go. We need to not only pick the right direction on the stock, but pick the right option to take advantage of that expected movement. Now, when volatility increases, the price of all options increases. Volatility doesn't see a difference between put and call. Volatility just sits there and sees options. It doesn't favor either one. When vol goes up, all option prices go up, puts and calls. When volatility goes down, the price of the option decreases. So if we're in a very high volatility situation, knowing that mean reversion exists and we're expecting volatility to go down, then when we buy an option, we better be careful as to what option we buy. Because if we buy the wrong option, one that's very sensitive to movements in volatility, then we might actually see our option decrease because volatility went down. We need to pick the right option at the right time for the right job. So, vol goes up, option prices get more expensive. Vol goes down, option prices get less expensive. We need to understand where we are in terms of the scale of volatility for what we're trading, and we need to know what's going to happen to the price of our options as vol reverts back to the mean. Volatility also wreaks havoc on the bell curve. Now, what we're looking at here is a price distribution at expiration. All three of these curves that you see are all bell curves. Let's just take a quick look at them and the differences between them. First, let's look at this low volatility curve. If you follow the arrow right to it, you'll see it's this one right here in the middle that's kind of tall and skinny. Remember we said that when volatility lowers, the stock's range lowers. Look at that. Look at the range as indicated by this bell curve. It's not a real big range at all. And if we are looking at that in relation to our option strike price, a low volatility stock with this option strike price is going to wind up worthless, isn't it? The reason is because low volatility indicates a lower range of potential outcomes. We might not get a chance for the stock to move enough to bring this strike here into the money. However, if we increase volatility to a moderate volatility, more of an average volatility, look what happens now. Well, first we see the effect on the bell curve. The bell curve has flattened out a bit, but more importantly, its range has expanded. And because its range has expanded, now our strike price actually stands a chance. Not a great one, but now it stands a chance to become valuable at expiration. Why? Because the stock does have some chance of finishing above the strike, giving this option here value. That's why when volatility increases, the price of the options increase, because the range has increased. There's now more chance for this option to be more valuable. Finally, what if we jacked the volatility up and made it high? Look what happens now. Look at this bell curve. Believe it or not, it is still a bell curve. It's still symmetrical, and it still conforms to our standard deviation statistical references. So it is still a bell curve. But now look at our option. Our option becomes even more valuable now, doesn't it? Before, with low volatility, the stock doesn't stand a chance of getting up to our strike. Moderate volatility, it now has a chance, not a big one, but a little bit of a chance, increasing the value of the option. But now, under a high volatility scenario, there's a very good chance that this option could finish in the money come expiration because the range of the stock and its potential outcomes has increased so dramatically. That is why when vol goes up, the price of options goes up. When vol goes down, the price of options goes down. Why? The indicated range. More range, more potential. Less range, less potential. More potential, more value. Less potential, less value. Now, how did we get there? How did we get from a low volatility with very little potential of success for our option to a high volatility and a lot more success potential for our option? Easy. Look at our Plinko game. Here, with a tighter range, the balls have to stay in more of a controlled area. So we're playing our Plinko game, and what happens? First, what's the first step? Brownian motion moves us in. Then what happens? At every peg, random walk takes over, bouncing the ball in different direction, 50-50 each time. But here, we can see that the range of our Plinko game is much smaller. We're not going to get values out here and out here because the range won't let the stock get there. Here, the range won't let the ball get into any of these holes out here. Thus, we form a tighter, taller, skinnier bell curve. But if we take volatility up, we increase the volatility, we increase the range. And with more range, there's more potential values that the stock can stop at. So here, the balls have more of a chance, more outcome potential for the stock to be a lot higher or a lot lower. That's why that option then has more value when volatility is higher. So let's take a look at each individual one. Here's a situation of moderate volatility. As you can see, our strike price has a little chance. Not a lot, but a little. We know that the center of the bell curve, the mean, the average, is always what? The current price, right? We know that this is a moderate volatility. Why? Because that's the one I'm looking at first. We're looking at moderate volatility. Our strike price, although not a big chance, does stand some chance of success. But what if we increase volatility? By increasing volatility, we've increased the potential range of outcomes of the stock. By doing that, suddenly, this option that had very little chance under moderate volatility of becoming in the money now has a much better chance of becoming in the money. Because of that, more value is assigned to it. Starting with our moderate volatility and a small chance of success of this option, we now lower the volatility. When we lower the volatility, look what happens to our bell curve. It becomes what? Skinnier and taller. And look, now the potential range has diminished to a point that our option has very little chance, if any, of finishing in the money at expiration. That means the value of that option will have decreased because there's less chance of success. And due to that, volatility dropping decreases the price of the options. So here's that chart again. Give it a good look and see what I'm talking about with how volatility not only changes the bell curve, but because it changes the bell curve, it also affects the price of your option by either increasing the chance that the option will be in the money and successful, volatility going higher, or decreasing it, volatility going lower. It's very important to understand that because when we're trading in the options market, we need to make sure, we need to know for certain where volatility is, at what level are we dealing with. Because we might turn out to be right on our direction, but if we don't choose the right option to take advantage of that, and we select an option that is very susceptible to movements of volatility, and the stock moves in our direction, but volatility goes against us, we might actually have a loss in our option, even though the stock went in the right direction. Now, seriously, I'm going to ask you a question. Be honest. You're home alone. Nobody's watching. And just admit it to yourself. How many of you thought a stock was going to go up, and you decided on your own to buy an option? Raise your hand. Raise your hand. Okay. How many of you bought the option, had the stock go up like you planned, but still lost money? Why? Because you bought an out-of-the-money option and volatility decreased. Even though the stock made its way up in the right direction, the money that your option made from the stock movement was overwhelmed by volatility going down. All your profits from the stock movement were sucked away from you from the decrease in volatility. That's why you need to understand volatility. You don't use that out-of-the-money option in that situation. How many of you remember now you bought an out-of-the-money option, didn't you? The stock went in your direction and you still lost money. And you sat there, you threw your hands in the air and said, this whole option stuff is a bunch of crap. It's rigged, it's fixed, they're out there to screw me. How many of you had that attitude? Wrong. Wrong. You screwed yourself. Why? Because you didn't understand this chart right here. The effect of volatility on the options price as indicated by just simply how the bell curve changes. This little piece of information could have saved you money and, more important, confidence, psychological well-being. I knew the stock was going up. I knew to buy a call. I bought the call. The stock went up, and I lost money. You did not really, truly understand volatility and how it affects option prices. Volatility is a huge component of the price of an option. You need to understand it thoroughly before you start selecting strategies and picking options to fit in that strategy. Here's what's happening when you look out over time. You know that the stock is currently trading at 50. You know that is your center line. That's your mean, right? And when we go out 6 months to figure out where the stock is most likely going to be 6 months out, we have a range of values. We have that bell curve turned on its side, giving us a range of values. That bell curve shape and that total range is determined by volatility. That's how important volatility is. That and time, volatility and time, tell us what that range will be. The bell curve from there then assigns our probabilities. We need to know, are we in a high vol situation or a low vol situation? Look what happens to our range as we increase volatility now, the expected range of the stock. The range increases. We've got more range on the stock, more percentage chance for the stock to be higher or lower, giving you more percentage chance of your option being in or out of the money. More value, more uncertainty, more value. So you need to know and fully understand the workings of volatility. Volatility is separate and works independently from the other variables that control the price of options. The three big ones are the stock price, time, and volatility. You need to know that there are three factors that affect an option's price, and volatility is as big as any of the others, and it works mutually exclusive to the other ones. Vol can go up or down. It's got nothing to do with where the stock is, where the stock's going, how much time is going by. Vol moves independently, and you've got to understand what the chances of vol moving up or down are based upon your volatility cone, where you are in that little range of volatility levels, and what it could do to the option that you pick and that you choose to execute your strategy. That's why you need to know volatility. Chris, back to you.
All right, Ron, well, that was an excellent job. And as we said, volatility is the single biggest influence on the extrinsic value portion of an options price. Incredibly important that you have a clear understanding of how volatility works. Before you go on to the next section, which is going to be the Greeks, I want you to go back to optionsgps.com, go to the community and talk about volatility, what you know and the questions you might have. Ask those questions. Then take the quiz and make sure you pass that quiz before you go on to the Greeks. It's very important that you get volatility down. I'll see you in the next DVD, which is going to be the Greeks.